Just how concerning is that? Let's ask Cameron Dawson, Chief Investment Officer of Newedge Wealth, here with us at Post 9. It's getting a lot of attention. Regional banks are really selling off hard. I showed you what the Russell is doing. The four biggest banks today have lost near $50 billion in market cap. Yeah. What does it mean to you?
Well, there's nothing like a forced capital raise from a bank to wake the market up to the risk of higher interest rates and tighter liquidity. And that's exactly what we're seeing today. I think when we look at the Russell 2000, we should keep two stats in mind. 45% of the Russell 2000 is unprofitable. And then 40% of the debt that small caps have is floating rate. So they're not making money, they're unprofitable, and their costs are going up as the Fed is raising rates. And that's the stress of higher rates working their way through the system.
It raises the question as to whether what we see with SVB, and I want to show it again, it's down near 60%, is a canary in the coal mine. That, have we been looking in the wrong places for the, most acute fallout from what the Fed has done? We watch the job market. We say, the job market looks strong. We, of course, know what it's done to housing because mortgage rates and interest rates in general have gone up. But maybe we've been looking in the wrong place.
Well, I think that that's really important to note. And I think the one question is how systemic this will be. Do we see this cascade into other parts? We do know that SVB is particularly exposed to cash-burning companies. They fund venture companies, early startup companies. So these are the companies that are most at risk when the Fed raises rates and when liquidity gets tight. That's what we're seeing with them. There's also another dynamic that we're seeing deposits leave the banking system because they're going after higher treasury yields. And so that's what we heard from KeyCorp as well. That's why the other banks are participating in this sell-off, because deposits are going and finding higher yields.
Deposits are going and finding higher yields. What you don't want to do if you're one of the bigger banks is have to raise the interest rates on your depositors, because obviously the spread, the net interest margin, which we talk about all the time, it's like the bread and butter for the banking centers, that gets hit, and thus that becomes an issue in and of itself.
And I'll add on top of that the fact that loan growth is finally starting to slow down. If we look at last year in the H8 data, we could see that loans were still growing at over 10%, 12%. But in January, they slowed to 4% overall and 4% for commercial industrial. That shows you that pinch from higher rates.
Let me read you what BTIG's Jonathan Krinsky said today regarding this very issue and what it may mean to the broader market itself. We would argue that banks and semis are two groups that historically have been very good leading indicators. Typically, markets can do okay if either of them are languishing, but when one of them is having an outsized move, it's usually wise to listen. In this case, the outsized move is clearly banks to the downside. As we wonder kind of where we are and where we're going in the midst of a 12 or so day stretch that is so super critical, from Powell on the Hill to the jobs report tomorrow to CPI and PPI and retail sales, all of it culminating with the Fed meeting on the 22nd.
Well, there's all these conflicting messages because, as you point out, semis are strong. The rest of cyclicals are strong. Look at industrials, how well they are trading. And yet the yield curve is deeply inverted and you have all these recession fears. And so there's mixed messages. But I think that the message from the banks shouldn't be ignored. The message from small caps shouldn't be ignored, because those are the leading indicators of what you're starting to see financial stresses emerge.